Welcome to this ValueBridge.net case study. This time we'll take another look at ESG and estimate the equity return impact of certain initiatives in private equity deals. Specifically, we will model initiatives that reduce a company's gross profit margins, but also have the potential of increasing portfolio company revenue. So there's a trade-off with a break-even point that we can identify with a fairly simple equation. Here we have a consumer product that everyone in the world needs, but unfortunately, key components in the manufacturing process have historically relied on the exploitation of misty mountain dwarves. However, we think these components might be replaced with renewable alternatives that are sustainably harvested by merry bands of Mirkwood elves who are paid a living wage. Unfortunately, shifting to more sustainable inputs is going to be expensive. It increases the company's COGS and reduces gross profit margins. And this is generally not good because it reduces the company's EBITDA. Holding other factors constant, this would decrease the company's enterprise valuation, which also has the effect of reducing shareholder equity value. But wait, not so fast. It turns out that consumers love our cleaner and greener positioning. They line up in droves to buy the devices, and we end up increasing revenue through increased volume, higher prices, or both. This allows us to flip the EBITDA positive despite the higher variable costs, and this increases the company's enterprise valuation and also causes shareholder equity to grow. Let's see an example of how this can work. Here we have a company that's worth $100 million. It is capitalized with 50 of equity and 50 of debt, so its equity ratio and debt ratio are both 50%. According to the company's income statement, TTM revenue is 80, cost of goods sold are 32, which provides $48 million of gross profit. Next we have SG&A of 28, which leaves us with $20 million of TTM EBITDA. We have three margin measurements here. The gross profit margin is 48 over 80, or 60%. The operating expense margin is 28 over 80, or 35%. And the EBITDA margin is 20 over 80, or 25%. Finally, we have the company's EBITDA valuation multiple of 5.0 from the enterprise valuation of 100 over 20. Okay, now let's keep as many of these metrics as possible constant and then layer on the ESG expenses to see how they influence the capital structure and P&L. We'll keep the company's debt level the same, and for now, we'll also keep the revenue constant. In this example, we can also lock down the SG&A, the operating expense margin, and the valuation multiple. Let's say that at current production levels, the sustainable inputs cost the company $4 million per year. This will reduce the gross profit to $44 million and reduce the gross profit margin to 55%. These higher COGS make the EBITDA margin drop to $16 million, which reduces the EBITDA margin to 20%. That would make the enterprise valuation 5 times 16, or $80 million, which makes the total shareholder equity fall to $30 million and provide the following equity and debt ratios. This represents a total loss for the shareholder group of $20 million, or 40%. A value bridge can quantify the causes of this change, so let's add the necessary data, the differences, averages, and equity return multipliers as follows. Gains and losses from changes in variable costs are explained by gross margin expansion, which is equal to the change in the gross profit margin times the average revenue, valuation multiple, and equity ratio. Plugging in numbers from the table gives us a loss of minus $8.75 million. That is short of the $20 million total equity loss because we're missing gearing. In a levered deal like this one, debt on the balance sheet amplifies equity gains and losses. Gearing is the change in the enterprise valuation minus 20 times the average debt ratio of 56.3. That's equal to a loss of minus $11.25 million, and these two numbers add up to the correct total equity loss of minus 20. Okay, now let's clear this whiteboard and allow the customers to respond to the company's new cleaner and greener positioning. Given the high demand of ESG-friendly products among consumers, we increased the company's revenue from 80 to 90 million. We'll keep the gross profit margin fixed at 55%, so the gross profit goes up to 49.5 million, and the COGS must be 40.5 million. We keep the company's SG&A unchanged at 28, so now EBITDA increases to 21.5. The operating expense margin is now 28 over 90, or 31.1%, and the EBITDA margin is now 21.5 over 90, or 23.9%. These changes make the company's enterprise valuation 5 times 21.5, or 107.5 million. And since we still have net debt at 50, total equity value would increase to 57.5 million. And provide the following equity and debt ratios. This time, the overall impact of the ESG initiatives is to increase shareholder equity by 7.5 million, or 15%. To quantify the value drivers, we measure the differences, averages, and equity return multipliers, just as before. Revenue growth is equal to the increase in revenue times the average holding period EBITDA margin, valuation multiple, and equity ratio. Plugging in the numbers in the table gives us positive $6.32 million. Gross margin expansion is calculated exactly as before, providing a loss of minus $11 million. Since we increase revenue on a fixed SG&A, we must also account for operating margin reduction. Minus the change in the operating expense margin times the product of revenue, valuation multiple, and equity ratio gives us positive $8.55 million. And finally, since this time we increased the company's enterprise valuation, gearing now gives us a gain of $3.62 million. We see that these four value drivers add up to the correct total shareholder equity gain of $7.5 million, so we can rearrange them into a value bridge that explains the difference between the pre-ESG equity valuation of $50 million and the improved post-ESG equity valuation of $57.5. Now, this is an illustrative and oversimplified example, but our models are equipped to deal with much more complicated situations. If you download the Excel file on the case study page, you can also see what happens when ESG investments influence a company's debt levels, fixed cost, and valuations. But when we limit the model to just a few factors like margins and revenue, here we can identify hypothetical break-even points and estimate the amount of revenue growth that we need to make up for any given increase in the company's variable costs. A fund or GP's gross multiple of invested capital is equal to the fund equity value at time 2 after the ESG investment divided by the value at time 1 before the ESG investment. According to the logarithmic model, that's equal to the product of the revenue at time 2 divided by the value at time 1, EBITDA margin at time 2 divided by the value at time 1, valuation multiple at time 2 divided by the value at time 1, equity ratio at time 2 divided by the value at time 1, and the fund ownership percentage at time 2 divided by that value at time 1. Since we are looking for a break-even point, we first set the gross multiple of invested capital equal to 1. And in this example, we don't change the company's valuation or ownership percentages, so we can set these terms to 1 as well. Now, the equity ratio is important, but in our example, it only moves because it's downstream from revenue and EBITDA margin changes. So for the purposes of a break-even analysis, we can also set this to 1. That leaves us with this equation, where the product of R2 over R1 and EM2 over EM1 must equal 1. But revenue times an EBITDA margin is just equal to the EBITDA, so this becomes the EBITDA at time 2 divided by the value at time 1. This tells us that we're going to hit break even whenever the EBITDA after the ESG investment is equal to the EBITDA before the ESG investment. Now, EBITDA is equal to gross profit minus SG&A. But we didn't change SG&A in this example, so we can cancel these terms out. Gross profit is equal to the product of the revenue and the gross profit margin. So we can make this substitution, which allows us to say, the final revenue required to make up for any given increase in variable cost is equal to the original revenue times the pre-ESG gross profit margin divided by the post-ESG gross profit margin. This is perfectly accurate, but it can help to rewrite R2 as R1 plus the required revenue increase delta R. Then when we move R1 over to the right like this, we can say that the required revenue increase is equal to the original revenue R1 times the gross profit margin ratio minus 1. In our example, we had an original revenue of $80 million, so to make up for the ESG-driven changes in our gross profit margins, we need to increase the company's revenue by at least $7.27 million. I hope that you found this helpful. Check out the case study page of valuebridge.net where we lay out all the math and provide a Microsoft Excel template for download. Don't hesitate to reach out to me if you have any questions. Thanks for watching, and see you next time.